Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Wednesday, the 6th of July, Bull versus Bear webinar. Steve Marley on the call for Trade Day. Welcome, everyone. We'll go through our usual regular run through. We'll take a look at the calendar, what we've had, what we've got coming up on the data front. We'll take a look at the macroeconomic fundamental geopolitical events and occurrences that are impacting financial markets right here, right now. And then we'll take a look at some charts to see where the potential lies in the markets going into today. Let's kick off with the calendar in here. Fairly light calendar in here this morning. Construction PMI from the UK, not a massive. Did miss expectations, but not really a huge piece of data. Focus really elsewhere. Eurozone retail sales, slightly missing expectations as well. So all of these telling us the story, though, of what we've seen coming through in here of growth numbers, any kind of economic growth numbers starting to wane, starting to feel the impact of the higher interest rates, starting to feel maybe the impact of inflationary pressures. So we're certainly seeing that coming through. Going into this afternoon, where's the focus going to be? Well, because of the US holiday, we had all the PMI data from S&P Global. We got it all yesterday for most economies. Because of the US holiday on Monday, we're getting it from the US today, and we also get the ISM data. So this afternoon at 9:45 Eastern, we get the S&P Global. Now, remember, this is not watched as much as the ISM number for the US. The S&P Global data used to be market data. Market as in MARKIT, not market data, the company market. So this piece of data is important for global economies because we don't get it from all the national economies. So for all the global economies, we want that data. But it's for the US because the ISM data, the Institute of Supply Management, is a longer stream of data. We tend to see the ISM data as more impactful onto financial markets. So, but we're still going to watch the S&P Global data. So the composite and the services sector data comes out at 9:45 Eastern, and then 15 minutes later, we get the ISM non-manufacturing, which is a de facto services PMI data coming out at 10 o'clock Eastern. That's going to be important. We're going to watch that. And we also, ahead of there, at 9 o'clock Eastern, Williams from the Fed is speaking. Most important probably to watch today is going to be FOMC meeting minutes. Okay, so all eyes on that. Going into this evening in the UK. Sorry, I've got my UK head on. This evening, UK, 2 o'clock, 1400 hours Eastern time. So certainly watching that. If you're trading oil, you're obviously going to be watching your weekly data, the IPA, API, even weekly crude oil stock data, 16:30, 4:30 p.m. Eastern time. So, there's our data for today. Quite a fairly busy day, important data. The PMI data is certainly important for growth, watching for growth. And then clearly those Fed minutes this afternoon at 2 p.m. Eastern are going to be much watched to see if we'll get any more inkling. The Fed have been very, very transparent on what they're trying to do. But whether we got any inkling in here, obviously they did the 75. We had a very quick move from expectations last meeting from a 50 basis point hike to quickly within literally 4 or 5 days because we got that high number on, was it the CPI? They got the high CPI print. And then there was a big shift from expectations of a 50 basis point hike to a 75 at the last meeting in June. Let's take a look at what we've got going into. So it'd be interesting to see what their thought process were. Let's go and take a look at what the CME group tool in here, the Fed Watch tool, is telling us. And what we're seeing in here is they're kind of nailed on for a. If you look here, it's the current target. We're at 150, 175. That's what the current rates are for the Fed. And so we're now pretty much nailed on now for a 75 basis point hike from 150, 175 to 225, 250. So that's what we're looking for, 75 basis point at the next meeting you see here on the 27th of July, the end of this month. However, this column is starting to go slightly lower. This at one point was up way into the high 90s. It's starting to fall in here. And now, a slightly growing chance of maybe only a 50, because obviously this is clearly the rate hikes that have already gone since the beginning of 2022 are starting to impact onto the US economy. We're seeing, and also the global interest rate hikes that we're seeing from other central banks are impacted on the global economy. And so we're seeing slowdown. We're seeing the growth numbers starting to roll over. Inflation, as we said, I think I said it yesterday's webinar, the data we're seeing, the PCE data last week in here, certainly starting to show evidence that we are potentially moving more to the CPI, the inflationary pressures rolling over. The core PCE data last week, remember, was at levels seen in November. The core PCE data has been falling. And remember, this is the Fed's measure. This is what the Fed tell us they watch. And that's been falling for the last 3 months. It peaked 2 months ago. So actually, the last 2 months it's been falling. And now it's at levels seen back in November. So there are signs. But remember, that's the core data. The core is X excluding food and energy. And obviously, food and energy are where the real issue lie. With this, it's energy prices globally, but particularly being driven higher in Europe because of the Ukraine-Russia situation. Global prices of food are also being pushed higher, again, partially to do with the conflict in Ukraine. But they are also starting to roll lower. Food has definitely been rolling lower. Food prices have peaked and have moved back lower. Oil has clearly moved back lower. And we've seen a big sell-off in oil, huge sell-off in oil yesterday. So all of this is kind of telling us that inflationary pressures might be beginning to recede, right? And then also we're seeing growth is starting to be impacted. So this is going to maybe start to shift central banks. I'm not saying they're not going to hike anymore, but what I'm saying is peak rates might be coming earlier and at lower levels than previously expected. So this is already starting to tell us this. Also, if you go out to the September meeting now, look what we got as the biggest chance in September by some way in here is for us to be 125 basis point up from where we are right now. So that's pricing in a 75 and a 50. If you think we're going to get a 75, this is telling us 75 at the July meeting now. If we go to the September meeting, this is telling us now we're going to get a 75, then a 50, okay? And maybe a chance in here, slight outside chance of only 250s, okay? In here, this is telling us over here. And if we go out all the way into next year, if we look at where peak numbers are, so peak is bringing us in at 325 to 350, okay? 325 to 350. So that's up from here, 175 basis points from here, 1.75% up from where we are right now. We're currently at 1.5 to 1.75, going up to 325, 350. That's what it's telling us going into. So we go to February in here, 325 to 350 is the expectation. And then we go out to March, 325 to 350. So we're already hinting at here, if you look in December, where we're going to be in December, 325 to 350. If we go in here, so we're looking for rate hikes right the way through to the end of the year. So November is telling us 300, 325. And then December is telling us 325 to 350. That's peak rates, 325 to 350. And then from next year, it stays at 325, 350 through February, through March meeting. That's still the peak. And then when we hit in here, May, 325 to 350, but these columns in here are growing, that we're going to potential for rate cuts by May of next year. And if we go to June, then it's 300 to 325 is the peak, which is telling us by the summer of next year. So basically rate hikes through to this is telling us rate hikes through to the end of the year, to the December meeting, then pausing through the first half of next year. And then by around May, June, looking for rate cuts to be coming in. And this is, and as we've been watching this, I've been coming back to this, every few days, every week in here, this is starting to show growing chances of one, the peak being lower, and two, the peak maybe being coming sooner, and then also maybe the rate cuts coming sooner. So there's a slight inclination that we're moving slightly to a more dovish stance in here coming through from the central banks, because clearly the policies that have been put in place are starting to work. Okay, I know this is all kind of bigger pictures, but I just want to paint that bigger picture for you guys and where we're at, because there is a big focus now. Remember, we were talking on the webinars only like 1 to 2 weeks ago. We were talking about inflation. All the headlines from Bloomberg, from Reuters were all about inflation. Now all the headlines are recession. Concerns that already basically the concerns previously were that the central banks, the Fed in particular, were maybe behind the curve, i.e. the market was wanting more aggressive rate hikes, that the economy needed more aggressive rate hikes to control inflation. It was all concerns about inflation. Now the fear is, okay, that's been put in place. Is there now a risk that the Fed now not have gone too far because they need to obviously control inflation, but now that we could be pushing into recession. So all the headlines are about recession. Okay, so and that's obviously then seeing the market now start to price in potentially not as aggressive tone from the Fed and from other, and that's kind of been the story for other central banks as well. So let's take a look at 5 things you need to know to start your day. So, for that reason, we've seen a big rush into the dollar in the last 24 or 36 hours. The dollar has surged higher. The euro has got smashed because, again, the euro in here there's a potential for, even if we do go into a recessionary pressures, that maybe the ECB won't get really that started. We are expecting the first rate hike from the ECB, but potentially the ECB will stay far more dovish, and that puts negative pressures on the euro, alongside the fact that the euro is showing signs of potentially dipping into a recession more than the US is. So the combination of those has seen the euro got smashed, and often when the euro gets smashed, other currencies get hit against the dollar as well. So the last 24 or 36 hours, we're seeing the EUR USD, euro versus dollar, sell off. But then we've also seen broad dollar strength. Now, the euros are what do we say, something like a 20-year low against where are we in here? So extends fall to 103.23, doesn't say. Yeah, but there's a lot of talk about it going to parity. It's fallen again in here. Where are we at the lowest level? I know we took out the 20-year low. So for the euro, it broke down through in here, the 2017 low. And now it's at a 20-year lowest point since back here, beginning of the century, back in like 0203. It was below parity. The euro the inception of the euro was 1999. It did trade below parity around the turn of the century. So I was obviously in the markets back then. But the euro continue to be negatively impacted. And part of that as well, that they're talking about it here, is the problems with energy. We've seen gas prices surging back higher in here. We spoke about those yesterday. European gas prices, natural gas prices, surging higher because of issues with what's going on Ukraine, Russia in here, sending those prices higher, and real fears that that's going to continue to put upside pressures on inflation, and also then potentially tip Europe into a recession. A lot of issues going on around Germany and gas, and potential for shortages. All of this so they're talking about it here. Look, possibly that Russia may cut off gas supplies to Europe and plunge the region into recession. So all of this having negative impact on the European economy. European stocks got smashed yesterday. The FTSE had a really, really bad day in comparison. The DAX as well. Really bad days in comparison to the US equity indices, which actually, I know we were lower originally on the US equity indices, but they did manage to show solid rebounds. But European equities in here not really doing anything like the job, hardly any rebound, and really got damaged. I think the DAX at 1.2.5-3% down yesterday, where if you look at US equity indices, actually finished flat on the day to actually up on the day. So European equity indices certainly getting hit a lot worse because of these fears about Europe going into recession, because of fears around energy, because of fears around gas, and because of fears about the inflation needs to be tackled, but the central bank is still very dovish. So the euro not benefiting from the fact that the ECB is naturally very, very dovish as well. Okay, went through a lot there. Let's go back to here. So the dollar's surged higher, but what we haven't seen, even though European equity indices went low, as I said, we've kind of gone into risk-off mode, but it's very kind of euro focused, and because of that, the US equity indices actually held in quite well. We also saw oil. Oil got smashed yesterday. A huge move down in oil. We said that it looked negative, and we said, did it have further to go? And we said, yeah, maybe it could go a bit further. I didn't expect it to go as far as it did. Copper's also getting smashed. Base metals are getting hit on the downside in here. Again, all of this echoing the fact that there's real fears about a global economic slowdown. So in all these base metals, industrial metals, getting smashed lower in here. They've got an article in here on copper. Actually, I think I've already got this one up. Copper in here. Look, copper crash deepens as recession fears dominates metal trading in here. So it is an economic bellwether. We spoke about it being a bellwether yesterday. It is the copper price reflects global growth, global economic growth, and it's very much tied to China as well. So China is seen as the manufacturing hub of the world these days, and copper is a big part of the input into everything that China does. Okay, so often when copper sells off, it's a reflection of the Chinese economy, and for Chinese economy, you can kind of read the manufacturing sector of the global economy. And it's not just copper, aluminium, nickel, tin, all these other base metals, these industrial metals, all getting hit on the downside, going to multi-month lows in here. And you can see that copper trading lowest level since late 2020 in here, so getting smashed. And it's been a real acceleration, been chopping in this range, a real acceleration lower over the past 2 to 3 weeks, but a real acceleration over the last couple of days as well. So again, that's echoing, reflecting the global slowdown in here. So one of the Chinese chip man is one of the bright spots in the markets Wednesday. So we are seeing some gains there. Tech did fairly well yesterday. We have to say Nasdaq, was a shallower sell-off yesterday. We'll take a look at it shortly on the charts. It was a shallower sell-off yesterday for the Nasdaq, and we did say an outperformance from the tech sector, and then it was stronger on the rebound. We'll see that in the chart shortly. Partly probably helped by, we've got on the charts in here. If we go and take a look at the bond market, so the bond market in here pushing up. Okay, so bonds up, higher in price. Remember, equals lower in yield. Okay, have I got the US 10-year in here? I've got US government bonds on here. I can go and show us the US 10-year note. Where are we? US 10-year bond. Okay, look at the chart. We look at the 10-year actual yield. So obviously the other chart was we're looking at this is the futures price. Okay, the futures price. It's going to echo. It's the upside down version effectively. But you can see that pushing back to this peak in here on price that we saw back at the end of May. If we take that out, we're going to the highest price to the low, which will be lowest yield since back here, since April. Okay, and on yield terms, we're through the back up, we're down through 3%. So this is kind of the upside down chart. If I take it still on the daily chart, let me put it onto a candlestick chart in here. You can see this moved down lower in yield. End of last week, we broke back below 3%. This looks like a blow off top in here at the top now. If it takes out this level here to around 270, we're at the lowest level since here, as we said, from mid-April. So bond yields lower yields, lower long-term interest rates. That's deemed as positive for the tech sector, relatively positive, okay, because because of the fact that tech is full of growth stocks, and growth stocks are more sensitive to interest rates, longer term interest rates, short term and longer term interest rates. So lower longer term interest rates are more positive for the growth sector, and then de facto for the Nasdaq. So hence that outperformance in here over the past 24 hours. We're certainly seeing that. What else do I have for you? So European stocks go back over half their opening gains, with the Euro stocks up 1%. So stocks did rebound this morning in Europe on the back of the fact that we saw the US equity indices rebound later in the session. That was after, remember, the cash markets were closed. So if you're in the US, cash markets in Europe, depending on the exchange, close anywhere between 4 and 6 p.m. Same as they do in the US, but 4 and 6 p.m. obviously local time, which if you're in the US, it's going to be around lunchtime, say Eastern time. Okay, so 12, 1 o'clock, whatever, depending on the exchange, depending on the exchange, depending on your time zone in the US. So they didn't pick up that rebound that we saw in US stocks that was later in the session, in the afternoon session. So they kind of played catch up this morning, okay, but they played catch up and then dipped as well. So they're still under negative pressure, having got hit significantly lower through the morning, through the session, for the European session, so the US morning, back yesterday on Tuesday. And what do we have coming up? Well, obviously the focus on the FOMC, and we've already gone through what we're looking for today. Right, let's run through some of the headlines. We spoke about copper. It's the same one in here, so I've got the same article there on copper. And then look, so US futures bonds swing as a recession fears thinking. So yeah, recession fears are lingering here. We've had a slight dip in here. Last time I looked, actually, let me double check in here. Slight dip this morning, yeah, but I mean a real modest dip in here this morning on US futures. S&P, Nasdaq end higher. So this is a recap from yesterday out of Reuters. This is from last night. End higher as investors eye economic path. So, I mean, what does that mean? Nothing really. Okay. But energy shares obviously got hit yesterday, and technology shares did really well in here. What else do we have? Oil. So oil got smashed on the downside, hence energy shares. Oil hit by more than $10 yesterday, and particularly Brent crude. Okay, so you got obviously what we look at and we trade is the WTI contract. Okay, but Brent crude particularly, that's like European crude in here, got hit on the downside. A slight rebound in here this morning, but nevertheless, significantly hit. And we'll look at the chart. And again, that's on growth theories. Okay, but then we got what you have to remember as well is that a lower crude price takes some of the inflationary pressures off. So that's kind of could be seen as deemed as a positive as well. Copper article, and again, copper in here from Forex Live. Copper's tumbles to 20-month low. The pound's under negative pressure now. Not only, so the dollar's strong. So pound dollar cable, it's called pound versus dollars cable, broke back below the 120 mark. But there's a lot of political chaos. It looks like we've had in the UK. It looks like we're about to, I don't know, not a definite, but the Prime Minister might have to resign. A lot of his cabinet, that's kind of his close confidants in here, have resigned in here. The various state secretaries, as it were, if you're in the US, the equivalent of that. So like the Chancellor, who is in charge of the financial side, it's kind of the equivalent of what Janet Yellen does. And then we also have the Health Secretary. They're resigned in here. So senior people within the cabinet are resigning in the UK, and it puts the Prime Minister Boris Johnson under pressure. There are calls for him to go, and it's likely that he will go at some point in the coming days or weeks in here. We've spoken already about euro. Euro falling further in here this morning, down by over 0.5% in here, and a lot of talk about it going to parity. We're at 20-year lows in here. Parity is just a number. Parity to the dollar, that's 1.0 to the dollar, and wouldn't be surprised to see that in the coming, if not this week, going into July certainly. Euro sinks to edge of dollar parity, as pros call it, unbuyable. So again, negatives there. And sterling as well. Okay, look, Boris Johnson clinging to power. Sterling lower. We've already covered that. Let's take a look at where we are going into today. So European stocks have rebounded. You look 1.5%, 2% up in here across the board, with US stocks that rebounded, but obviously down in here. If we go and take a look at something like the DAX, even though the DAX is up, let's hope this shows. Actually, I don't think this is a very good. Doesn't want to show you the chart. The actual. Can we zoom in? Does it give you any more than that? No. So it is showing a rebound in here, but it's not recouped all of yesterday's losses. You can't really see it in there on the chart. But the DAX, for example, hasn't recouped. It's down, still down net over the last 2 days, even though it's up like 1.3% this morning. It was down like 2.5%, 3% yesterday. So not recouped yesterday's losses, even though it has rebounded. If we go and take a look where the US is in here, so the Dow did ended up down. The S&P was unchanged. The Nasdaq ended up fairly healthy. Up yesterday, having had that big sell-off, and we'll see it better on the chart shortly. And in here this morning, we're down between 1/10 and 2/10, maybe up to 0.25% down this morning, but having had solid rebounds yesterday. We've already covered the Fed talk. Let's go look at some charts. So we already spoke there about the fact that higher bond prices, this is the 10-year note, higher bond prices equals lower bond yields, and that's been healthy for the Nasdaq. And I'm going to start off really with the Nasdaq in here. Look at that. So there's the dip and the rebound. Look at the dip. So it was a shallower dip yesterday for the Nasdaq. We held above the low there from last week on the Nasdaq, and it was a really strong rebound. And we ended up, significantly up on the day. Now we have had a little dip this morning, but so you can see it's shallower dip. It was less damaged on the downside. Normally, remember, when we're selling off in here, for example, the Nasdaq leads the way lower. It didn't lead the way lower. The broader indices, the Dow and the S&P, were actually down more than the Nasdaq. So it was holding in, and that's partly to do with what we discussed. Looked at Chinese chip numbers in here, tech kind of outperforming in here, and also because of that interest rate, the longer term bond yields falling. Okay, so that's healthy. If we compare that to where the S&P is, so look, we had a far more aggressive sell-off in here. We basically just went right down to the lows of last week on the S&P, so it was more negative technically. And although the rebound, and we did end up kind of slightly positive on the day, marginal positive, nowhere near as positive as the Nasdaq. It's still a positive section of the Nasdaq, but what I want to show here is that it was really the Nasdaq that was more resilient on the way down and more aggressive, more bullish on the way back up again. So let's zoom in and take a look at this on the 15-minute chart now. And where does it set us up? So effectively, look, we went down to these lows from last week, held above. We put these. Look, I drew these lines in the sand. We did break the initial. We broke that low there. We were holding above that low there, and said, you could have a short, and you would have made money if you'd shorted, but you would have had to cover before these lows in here, and then a really strong intraday rebound from above these two sets of lows, all the way back up through the previous highs here. Now this is a basing pattern. You'd argue this is a triple bottom, right? Yeah, triple bottom. And also remember we had this low over here, held at this low over here as well. Okay, so previously held at this low at these lows, and then held at this low in here above these two lows in here. So you got on the sell-off that we saw in here from last week, from late June through early July. So it's all just late June. This late June sell-off, which if we go back to the daily chart, is that sell-off there, that sell-off there. Okay, in relation to that, we're putting in a bottoming pattern in relation to that sell-off, and you've got a triple bottom. You could argue even a quadruple bottom, right? 1, 2, 3, 4 lows, all in that kind of vicinity there. I'm going to just put one big, if I can manage to do this. I'm not good on the drawing tools on this. Oh, that's not worked too bad. There you go. So you've got these 4 lows in here and the bottom going in there. And then obviously we've broken above the peaks. So where is it confirmed? Well, it's confirmed when we go above the highs, the intra highs between the lows in here. And you've got not only that high there that we broke above, but you also had these peaks over here, right, in relation. So this one in here we respected. So this was back on the 5th. So at one point, that was the initial rally we had yesterday morning, okay, before. So this was in Asian time. We had the rally, then we saw the sell-off and then the rebound. So it respected that. So this was a really important area to get above. We spoke about this 11,748. Okay, and now look, it's using it as almost like resistance. So if I put that horizontal, I'm going to just zoom across so you can see it a bit better in here. Okay, and if I put in a horizontal line, so these peaks in here, so you can see here. Okay, so you've got the peak here and the peak here. And now we're kind of using that as support. Now we are dipping back low, down below there at the moment, okay? I wouldn't be surprised to see a little bit of a deeper dip. And now we're going to be looking at where can it dip to and where's our buy opportunity. And what I'd be doing here is I'd be putting on a fib. Okay, so you've got a potential little topping pattern. The market's kind of a little hesitant. I'll be putting on that fib and looking at, here's the 38.2, okay? You've got these important lows in here and here. So you've got a low there, look, see that little low there on the 15-minute chart and another low there. So you've got these lows here as well. I've got to be important. But I wouldn't be surprised to see us. I think you can, there's 2 trades in there. You can venture a short if it breaks down from here because you've got then a topping pattern. You've got a double top up here, right? Double top, high, high. It breaks through that low and that low there. So we're in the vicinity, well, that low there is 11,729.75. What's this one? 11,731. So through basically 11,730, it looks kind of negative and could see a deeper retracement. I wouldn't be surprised to see it though holding this region here between the 38.2% and these lows here where we got this impulsive move higher. So somewhere between, maybe a setback down towards 11,685 to 11,650 in this zone here, between here, and then looking for a buy opportunity. So maybe a short, but only if it breaks this low. Only if it breaks down through 11,730. If it holds 11,730 going into the cash open, it could easily be back higher. It could just be very quiet going into the Fed though. It may not do very much into the Fed today. We may have to wait to the Fed before we get the actual proper move for today. I'm not going to do all the same analysis on the S&P, but it's kind of similar. Dip and a rebound to here. You can see on the intraday, on the daily chart, but not as positive. We haven't taken out that peak. So again, you've got the potential for a quadruple bottom down here. Take off some of this old analysis, but you've got the potential for a quadruple bottom. 1, 2, 3, 4 lows. Okay, down here. Certainly a double bottom. So right through here. Okay, you got that quadruple bottom, but it hasn't broken above the peak. Yeah, the peak that was from yesterday, early in the Asian time yesterday. Okay, needs to take out that high. At the moment, the market's kind of chopping sideways. So at the moment, I've got again, the risk is probably for a little deeper correction, but still looking for that swing high. So you could be short initially, particularly if it breaks below the low there. 38.0875 takes out that low, probably looking for a little bit of a deeper correction, but then looking to re-enter longs between 3800, 3790, somewhere in there for it to swing back higher. So maybe there's 2 trades in there for today, but again, Fed's going to be important, so we need to be watching on the Fed. Right, Going to quick nod, going for about half an hour now. Quick nod to the commodity markets, and then we'll wind up. So we spoke about could gold go any lower, and certainly did go lower yesterday and lower again this morning. This is because of dollar weakness. That's dollar strength. Excuse me, dollar strength translating into gold weakness. Okay, there's a long-term inverse relationship between gold and the dollar. So gold down equals dollar. Dollar up equals gold down. We saw a plunge yesterday. We did look for opportunities. It was already, I said it was maybe overstretched already, but it did go significantly lower. We took out some important lows down here. And now, really, there's no reason I don't think this could go significantly lower. Maybe sub 1740 towards 17 30 in here today. Easily could get down to there. So watching out for that, it will need another bout of dollar strength. You need to keep an eye. If you're trading gold in here, you need to have an eye on not only the dollar index, okay? So you've got the dollar index here, pushing higher. So as dollar index is pushing higher, that's sending gold lower. But also then, dollar index, a big part of dollar index is EUR USD. Keep an eye on the EUR USD. Get a euro dollar chart up. You need to be watching euro dollar. If euro dollar breaks lower, gold's going lower with it, okay? Because that's where the correlation is right now. I could only advocate shorts in there at the moment. If you go and look at the 30-minute chart in here, look, dead cat bounce. Plunge yesterday, no bounce. Dead cats don't bounce. No bounce, lower again. Slight bounce, lower again. Looks vulnerable. Looks like we're going lower into today. Oil smashed yesterday. Massive down day. Okay, we said, we did the ATR in this. Remember yesterday? How much more could it go? Did it have enough scope in it? Well, it went a lot further, blew out, the typical trading ranges. Just held above this low over here. This low over here, 95.47, okay, and had a slight rebound overnight in here. I think this is setting up for another down move into here. Whilst below these overnight peaks here and here, we're in a coiling consolidation now. But this is like a typical flag pattern. So with the flag pole, remember, the flag flies at half mast. So, this is then the flag's in a bear market. So bear move lower, aggressive move lower. We rebound, we go into this kind of flag formation. So where are we? We're in this flag now. Okay, like through here and through. Arguably through here. Okay, and then usually you get the continuation. And the measure of the next move is that move projected from the breakout. So if we break out below the overnight little low in here, the low from the last hour or so is 99.58, and then probably more significantly through that low there, 99.03 down through there. This could open up. Yesterday we dropped $10. I'm not saying it's going to drop another $10, but it could easily drop another $5, $6, $7 from here. So breaking through these lows will be the signal for a potentially another aggressive move lower. That's what this pattern will tell you. There's the flagpole. It flies at half mast. So if it's a half mast, you extrapolate that down. If the breakout is from here, so it's going to take us down to $89 all the way down to here. Now, I'm not saying it's going to do that today, but it could do that over the next couple of days. Okay, so watching out for that. Okay. All right, guys, I'm going to wrap it up there. Please do send questions through. Please give us some comments through. The little chat box is underneath this live streaming video if you want to do it. If you're not on live and you're watching this on the catch-up, don't forget to fire me an email, steve@tradeday.com or support@info@, whichever you want to do. Just fire them across and I can answer anything. Go through stuff you guys want to focus on. I'm going to wrap us up there. Have a great trading day. Take care. I'll see you back tomorrow on the webinar.